Every day we normally do a thing called 3 Minutes on Markets and Money, and we talk about the markets and money. There you go. That's why it's aptly titled.
What a concept.
What a concept. So 3 Minutes on Markets and Money. I got something for you this morning. Markets rallied yesterday very nicely, and we started off the day kind of weak, but the market rallied back on that because the concern over what's happening in Iran is quickly dissipating. Markets are already factoring in the fact that this most likely won't mature into anything more than just really kind of talking and idle threats. And more importantly, the Federal Reserve as still continuing their large chunks of injections into the financial markets. So that's supporting asset prices. Again, markets not really concerned about the quality of earnings or economics, which continue to be a little bit soft here, but markets still really kind of focusing here on really kind of hanging around here at all-time highs. The earnings picture itself is really one of the more interesting things. The market continues to rally here despite the fact that earnings continue to decline. In 2019, at the beginning of April, actually in April of 2019, estimates for the end of 2020 were $174 a share in terms of reported earnings. Now, that's earnings after all the bad stuff. By the time we got into September, those earnings for 2020, now this is September of 2019, projecting forward to the end of 2020, earnings had dropped to 166. Now, as of December, those earnings for 2020 going into this year are now down to 161, and they continue to fall. Now, here's the problem with this, is that markets are at all-time highs. Earnings are continuing to be ratcheted down for 2020, which means that investors are paying more and more for less earnings of what they're actually expected to get. So, in other words, if you take a look at the gross increase in the market last year, it was almost all driven by what's called multiple valuation expansion. In other words, investors paying more for the quality of earnings that they're getting. They're not getting any more earnings, they're just paying more in price. And this is really something that has played out here because, again, the market typically kind of follows along with what happens with earnings over time. As earnings are increasing, not surprising that the S&P rises. And when earnings fall, you typically see a decrease in the price of the S&P 500 as factors are being factored in for weaker earnings, weaker economics. But what you're seeing now is the markets continue to rise, even the fact that we continue to see deteriorating earnings and earnings quality, and the quality of debt is also becoming a real problem for corporations, but yet investors are ignoring this because of the Federal Reserve injecting money into the system. Again, the outcomes of this likely not good for investors really, or for the markets or the economy, your money in particular, as this becomes a reality later this year. So again, kind of watch that. But again, this is something that we talk about on a regular basis, and we have a report out today on our Technically Speaking post as well at the website. So simply go by realinvestmentadvice.com. Get our latest report. It's there for you, talking about kind of this technical backdrop to the markets, but also talking about this weakness in earnings and what could really kind of derail the markets over the course of really the rest of this year. So that's 3 minutes on markets and money for you, and we'll see you next time.